Between us, the global energy game is shifting incredibly fast, and what you are seeing on the surface is a complete illusion, masking a geopolitical chess match that is about to rewrite the rules of wealth. Hello, this is Warm Insight. Today we're going to talk about the hidden maneuvers in the global energy market, from dark mode, shipping to smart money positioning, and how you can protect and grow your capital in this exact moment. Leaving a like and subscribing is a huge help to us. Imagine you are sitting at a high-stakes poker table, in a smoke-filled room, but instead of chips, the players are betting the economic, survival, and sovereign integrity of entire nations. Everyone is holding their cards perilously close to their chest, their faces completely unreadable. But if you watch the board carefully, you can see new, aggressive players entering the room, and the fundamental rules of the game subtly changing right before your eyes. You are watching for bluffs, you are watching for tells, because the chips on this particular table represent trillions of dollars in global energy, infrastructure, vital shipping logistics, and national security paradigms. The macroeconomic reality that the vast majority of retail analysts completely fail to grasp is that the energy landscape is no longer simply about supply and demand, plotted on a sterile spreadsheet. It has violently evolved into a full-blown geopolitical chess match, and the pieces on the board are moving with terrifying speed. Let us examine a massive tectonic shift that is happening right now in plain sight, yet largely ignored by the mainstream financial press. Nations like India, representing over 1 billion people, and a rapidly modernizing industrial base, are quietly and systematically pivoting their entire oil sourcing strategy. For decades, India relied heavily, almost exclusively, on traditional Middle Eastern suppliers to fuel its massive economic engine. But today, they are deliberately moving away from that single point of failure. Instead, they are turning to a highly diversified portfolio of sources, including striking massive new deals with Russia, Brazil, and Venezuela. This is not simply a matter of chasing the lowest price per barrel on the spot market. This is a profound statement about strategic resilience and national survival in an increasingly hostile world. Think of a grandmaster chess player who is actively securing their king by building multiple, overlapping lines of defense against unexpected attacks from any direction. By diversifying their energy supply chain across completely different continents and political alliances, India is physically insulating its domestic economy against regional instability. In the Middle East, to truly understand the sheer magnitude and gravity of this shift, we must look deeply into the historical context of the 1970s oil shocks. In 1973, a sudden embargo by major oil producers triggered a catastrophic global energy crisis that literally brought the industrialized world to its knees. Prices quadrupled almost overnight, plunging robust economies into deep, agonizing recessions. Nations that had foolishly relied on a single geographic region for their lifeblood, energy, were entirely paralyzed. They experienced skyrocketing, uncontrollable inflation, massive, widespread unemployment, and severe political upheaval that toppled governments. The psychological scar left by that devastating crisis fundamentally altered how sovereign nations view the concept of energy security. The absolute primal fear of being cut off from the baseload power required to keep factories running, homes heated, and hospitals operating as a driving elemental force in modern global geopolitics. Today, as geopolitical tensions flare aggressively across the globe and regional conflicts threaten to disrupt critical maritime choke points, nations are ruthlessly applying the bitter, painful lessons learned 50 years ago. They understand with crystal clarity that, depending on a volatile war-torn region, is a catastrophic existential vulnerability. The rule of three applies here perfectly to sovereign strategy. First, a nation must ruthlessly secure its baseline energy requirements at all costs to keep its economy functioning. Second, it must actively mitigate external shocks by diversifying its suppliers across entirely different geopolitical spheres of influence. Third, it must project economic power by leveraging these new, diverse relationships to secure highly favorable, long-term structural contracts. The truly wild part about India's diversification strategy is that it is a permanent, long-term structural change, not merely a temporary fix to a passing crisis. It signals a definitive, irreversible fracturing of the old world energy order, leaving traditional suppliers scrambling desperately to find new buyers, while shifting the fundamental balance of economic power across the globe. Meanwhile, a deeply complex and highly volatile situation is unfolding rapidly across the European continent, centered around an impossible, agonizing dilemma that policymakers are desperately and unsuccessfully trying to solve. Europe is currently locked in a brutal, existential battle between its own aggressive, legally binding environmental mandates and its raw, terrifying fear of an imminent energy supply crunch. This vicious internal conflict is creating a massive, gaping vulnerability that other global players are already positioning themselves to ruthlessly exploit. On one hand, Europe has proudly committed to some of the most stringent, ambitious decarbonization and green energy transition targets in human history. They are rapidly trying to dismantle their fossil fuel infrastructure and shift entirely to wind, solar, and other renewables. But on the other hand, the abrupt, violent disruption of traditional energy flows, severely exacerbated by recent conflicts and sanctions, has left them staring directly down the barrel of severe winter energy shortages and crippling uncompetitive industrial costs. This is not just a polite policy debate happening in pristine legislative chambers. It is a psychological pressure cooker that is tearing the social fabric apart. The European energy security situation is flashing a bright, blinding red on the institutional dashboards, representing a massive, undeniable systemic risk to the global economy. To fully grasp this dynamic, we have to look back at the turbulent historical transition from wood to coal. During the dawn of the Industrial Revolution, when nations first made that monumental leap, it was not a smooth, perfectly planned, harmonious process. It was incredibly chaotic, violently disruptive, and driven entirely by the absolute, unforgiving necessity of outcompeting military and economic rivals. Those nations that successfully secured and mastered the new, denser energy source thrived and built global empires, while those who stubbornly clung to the old, inefficient system fell behind and were subjugated. Today, Europe is attempting an even more difficult and precarious transition, moving away from highly efficient, incredibly energy-dense fossil fuels to intermittent, weather-dependent renewable sources, all while blindly navigating a geopolitical minefield filled with hostile actors. The deep psychological insight here is the profound paradox of attempting a massive green transition during an acute supply shock, when household energy prices skyrocket and citizens can no longer afford to heat their homes. They demand immediate, decisive relief from their leaders, forcing those same governments to temporarily abandon their lofty, long-term climate goals just to keep the lights on and prevent mass civil unrest. You now see desperate governments quietly reopening heavily polluting coal plants, or investing billions in temporary natural gas infrastructure as emergency, stopgap measures, directly and embarrassingly, contradicting their own strict environmental mandates. This hypocrisy creates profound, chaotic market confusion for investors. Trying to allocate capital, the rule of three applies perfectly to this uniquely European dilemma. First, there is the noble, idealist goal of achieving a carbon-neutral, sustainable future. Second, there is the stark, terrifying reality of immediate baseload energy needs required to prevent total economic collapse and deindustrialization. Third, there is the immense geopolitical leverage. This very vulnerability hands directly to hostile energy exporting nations, who can turn the tap off at will. This agonizing internal conflict is a massive, glowing tell at the global poker table. It broadcasts clearly to the world that Europe's energy infrastructure is incredibly fragile, making them highly susceptible to price spikes, supply, blackmail, and political manipulation. Smart money. Institutional investors watch this dynamic with laser focus because they know from centuries of market history that structural fragility inevitably leads to extreme market volatility, which presents enormous generational opportunities for those positioned correctly to profit from the chaos. While Europe struggles painfully with its own internal contradictions and self-imposed mandates, another major global superpower is executing a ruthless, highly calculated strategy of domestic self-reliance. We are watching China's state-owned energy giant incredibly closely as they aggressively and systematically ramp up domestic offshore production in the Bohai Sea. Just recently, they officially started full, unrestricted production at the Kenley 10-2 oil field, an absolutely massive, sprawling engineering project with daily heavy crude oil output massively exceeding 20,000 barrels, and proven geological reserves well over 100 million metric tons. This is not a minor routine operational update hidden in a quarterly earnings report. It is a strategic geopolitical masterstroke, designed specifically to fundamentally reduce China's critical reliance on imported foreign energy by heavily investing in and securing a massive, highly stable domestic supply right in their own heavily defended backyard. China is granting itself unprecedented, unparalleled global maneuvering room. They are effectively and permanently taking their king completely off the chessboard, making it nearly impossible for external adversarial forces to hold their massive domestic economy hostage through naval, energy embargoes, or complex supply chain disruptions. The historical parallel here is absolutely undeniable and deeply revealing of how great powers operate. Look closely at the miraculous United States shale revolution that occurred in the 2010s, before the widespread, aggressive adoption of hydraulic, fracturing, and horizontal drilling technologies. The United States was heavily, dangerously dependent on imported foreign oil, leaving it constantly vulnerable to the political whims, embargoes, and pricing power of overseas producers. The unexpected shale boom changed absolutely everything overnight. It unlocked massive, previously inaccessible domestic reserves rapidly, transforming the United States from a desperate, pleading importer into a dominant global energy powerhouse and a massive net exporter. This singular technological shift completely rewired global geopolitics, giving the United States immense strategic leverage, stabilizing its currency and insulating its vast economy from external price shocks. China is now actively attempting to replicate a highly controlled version of this exact self-reliance through its massive offshore shallow, lithologic oil field projects in the Bohai Sea and the South China Sea. The underlying psychological driver behind this massive capital expenditure is the absolute non-negotiable necessity of sovereign control. In a modern world, where global supply chains are increasingly weaponized through tariffs, sanctions, and blockades, relying on foreign entities for your baseline, energy is accurately perceived as a critical, fatal weakness. The rule of three for sovereign energy strategy is glaringly clear for emerging superpowers. First, maximize your domestic extraction capabilities, regardless of the initial financial cost or engineering difficulty. Second, aggressively build massive, heavily fortified strategic reserves to buffer your economy against sudden, catastrophic global disruptions. Third, use the resulting energy independence to confidently project military and economic strength. Intense international negotiations. China's calculated move in the Bohai Sea is a loud, undeniable signal that they are preparing meticulously for a future defined by heightened global friction, and they are ensuring their massive industrial engine has the secure, uninterrupted fuel. It needs to keep running, absolutely, no matter what chaos erupts in the Middle East or across Europe. This strategic, highly defensive production increase is a foundational piece of the hidden institutional flow that is rapidly realigning the entire global energy market. Now, we must talk about a completely terrifying, profoundly dangerous signal that the vast majority of retail investors completely ignored, but that sent absolute shockwaves and alarms ringing loudly through the institutional trading desks in London and New York. We recently saw verified reports of major energy companies deliberately sending massive, incredibly expensive, liquefied natural gas carriers directly through the highly contested Strait of Hormuz in what maritime experts call dark mode. Dark mode means that these enormous vessels, carrying hundreds of millions of dollars of highly explosive and strategically vital cargo, intentionally and illegally turned off their automatic identification systems. They deliberately vanished from all global tracking radars, becoming massive ghost ships in the night. You must ask yourself, why would a massive, highly regulated commercial vessel willfully choose to sail entirely blind through one of the most congested, narrow, and dangerous maritime choke points on the entire planet? The answer is incredibly simple and entirely chilling. To avoid being targeted by military strikes or terrorist sabotage. This action is a glaring, undeniable, and screaming signal of extreme elevated geopolitical risk. The Strait of Hormuz is unquestionably the most critical, irreplaceable choke point for the entire world's oil and natural gas supply. A massive, indispensable percentage of total global energy consumption must pass through this incredibly narrow waterway every single day. When multi-billion-dollar logistics companies resort to operating in dark mode, it means their internal risk models indicate that the threat of physical attack, asymmetrical sabotage, or hostile state seizure is so incredibly high that the terrifying risk of a catastrophic maritime collision in the dark is actually preferable to the risk of being easily identified and destroyed by hostile actors. We absolutely must look back at the horrific tanker war of the 1980s during the brutal Iraq conflict to fully grasp the catastrophic severity of this situation. During that bloody period, massive commercial oil tankers were routinely attacked by fighter jets, struck by naval mines, and completely destroyed, leading to massive cascading disruptions in global energy markets and absolutely skyrocketing maritime insurance premiums. The psychological impact on the global shipping industry was profound and lasting. It clearly demonstrated that commercial vessels are not immune to sovereign conflicts, but rather, they are often the very first, most lucrative targets. The current terrifying dark mode transits are a modern high-stakes echo of that horrifying era. The deep psychological insight here involves the highly complex pricing of invisible risk. The broader, uneducated retail market almost always assumes that global logistics will simply operate smoothly and efficiently until a major fiery disaster finally makes the mainstream headlines. But the smart money tracks these subtle, silent, hidden shifts with relentless intensity. They constantly monitor marine war risk insurance rates, scrutinize obscure vessel tracking data, and analyze minute routing changes. The rule of three for global shipping logistics. Operating in an active conflict zone is critically important to understand. First, operators must prioritize vessel integrity and crew survival, far above any metric of operational efficiency or delivery timing. Second, they must actively obscure their supply lines to deliberately confuse potential adversaries and avoid targeting. Third, they will inevitably pass the astronomically high costs of these extreme security measures directly down the supply chain, ultimately driving up the price of the underlying commodity for everyone else. These frightening dark mode transits are absolutely not isolated random incidents. They are intimately, deeply connected to the violent fracturing of the old energy order, and they signal loudly that the global supply chain is incredibly fragile, highly overextended, and operating under extreme, unprecedented duress. So how exactly does the broader financial market react to all of this hidden maneuvering, escalating risk, and geopolitical tension? This is precisely where we separate the emotional amateurs from the cold, calculating institutional titans. Between us, the real, actionable story is exactly how the panicked herd reacts to the constant barrage of mixed economic signals, compared to how the smart money quietly, methodically positions itself for maximum profit. Retail investors are consistently caught blindly chasing daily headlines, driven entirely by raw emotion, fear, and greed rather than any coherent strategy. They see a slight, barely perceptible dip in the ISM, Non-Manufacturing Purchasing Managers Index, a metric simply showing that services sector momentum is slightly fading, and they immediately, irrationally panic sell their broad market positions. They look at a single, isolated data point and scream that a massive recession is imminent, completely missing the crucial, underlying nuance of the broader economic picture. For example, they completely ignore the fact that the manufacturing index might be simultaneously coming in well above expectations, demonstrating surprising, robust resilience in the industrial core of the economy. This conflicting data creates a confusing, blurry, and overwhelming picture for the average investor. They cannot mentally reconcile a slowing services sector with incredibly robust manufacturing and a highly resilient, tight labor market. Psychologically, it is exactly like watching a terrified rookie poker player sitting at that high-stakes table we discussed earlier. The rookie gets dealt a mediocre hand, sees a veteran player aggressively raise the bet, and immediately folds under the crushing pressure of uncertainty. They do not read the board. They do not study the other player's previous behavioral patterns. and they certainly do not understand the complex mathematics of POT, odds and expected value. This emotional knee-jerk reaction inevitably leads to massive, widespread mispricing across the entire market. The herd ignores the long game, focusing only on the absolute last card. That was dealt, completely blind to the larger strategy unfolding. But you must watch this carefully. The smart money, the massive institutional titans who manage trillions, they already know exactly how this game is played, and they exploit the herd's panic. They are absolutely not swayed by minor daily fluctuations in PMI data, or the latest hysterical panic spreading on social media. Instead, they zoom out and look at the massive structural shifts occurring on the global chessboard. We are seeing quiet, deliberate, massive shifts of institutional capital into long-term, highly resilient energy plays, specifically targeting assets deeply tied to strategic national interests. They are heavily buying into critical infrastructure companies, building diversified supply chains, and producers possessing distinct, unassailable geopolitical advantages. They fully understand that the electric vehicle boom is a very real, unstoppable long-term trend, with global sales rapidly accelerating past 20 million units. But they also possess the critical thinking and historical knowledge to realize that the massive, deeply entrenched traditional energy grid is not going to magically disappear overnight, or even in the next decade. They are absolutely not dumping their oil stocks in a blind panic. Rather, they are selectively, aggressively backing producers with strong, highly secure domestic production profiles, exactly like the companies operating the massive projects in the Bohai Sea. They are also quietly eyeing the specialized maritime shipping firms that possess the unique capabilities and risk tolerance to successfully navigate the dangerous, dark mode trade routes we discussed. The smart money strategy is entirely about cold, calculated risk management and ruthlessly exploiting the emotional, panicked mistakes of the retail herd. The Titan's playbook for navigating this extreme volatility is incredibly precise, mathematical, and unforgiving. The institutional bullish scenario for traditional energy rests firmly on the premise of persistent, escalating geopolitical instability, severely constraining global supply, while industrial demand from emerging economies remains surprisingly, stubbornly strong. If the Federal Reserve manages to expertly orchestrate a soft landing, keeping interest rates perfectly steady, without triggering a deep, destructive recession, the global demand for refined petroleum products and natural gas will remain highly resilient, driving massive, record-breaking profitability for integrated energy majors. Conversely, the catastrophic bearish scenario involves a severe cascading global economic contraction that completely destroys demand or a sudden, highly unexpected peace agreement that unexpectedly floods the global market with cheap, heavily discounted oil. Because both of these extreme scenarios are entirely possible, making purely directional, unhedged bets is incredibly dangerous and foolish. This unique dynamic creates the exact environment of the generational bargain, where heightened fear and volatility create incredibly sharp price swings and mispriced assets. The Titan's playbook strictly dictates a very specific, balanced asset allocation model. 65% in highly vetted equities, 25% in safe, stable yield instruments, and 10% in highly liquid cash, reserved strictly for tactical, opportunistic deployment during market panics. Within the equity portion, a massive core allocation must explicitly target integrated energy majors through a highly liquid vehicle, like the Energy Select Sector Fund, providing crucial stability and dividend yield across the entire energy value chain. The absolutely critical component of this strategy, however, is the exact mechanism of survival. In a market this intensely volatile, you absolutely must utilize disciplined dollar-cost averaging. You cannot arrogantly try to perfectly time your entry points, because the underlying geopolitical variables are entirely chaotic and unpredictable. By strictly committing to investing a fixed dollar amount at regular, predetermined intervals, you systematically and mathematically average out your purchase price, completely mitigating the devastating risk of deploying all your capital. Right before an unforeseen geopolitical crash, you must also ruthlessly implement strict stop-loss orders and actively consider deploying protective options. Strategies like buying put options to hedge your downside exposure. You want to slowly initiate these positions specifically, when crude oil demonstrates sustained technical strength, decisively breaking above key resistance levels, which confirms the market is heavily pricing in the geopolitical premium. What you absolutely must avoid at all costs is making highly concentrated, deeply speculative bets on a single narrow subsector based on a fleeting, sensationalized news headline. The global energy market is a deeply complex, highly interconnected web of geopolitical, economic, and technological forces, and narrow speculation will inevitably result in catastrophic losses. The energy market, while perpetually volatile and continually subject to the terrifying whims of global geopolitics and shifting macroeconomic policies, offers completely unimaginable opportunities for those few who truly understand that short-term headline-driven tremors almost always obscure the much deeper, entirely unstoppable underlying currents of global demand and rapid technological evolution. History shows us repeatedly, without exception, that severe energy crises serve as the ultimate, most powerful catalysts for human innovation, ultimately reshaping the entire global economic landscape and creating massive generational wealth for those who can see the chessboard clearly and act without emotion.